Hello everyone, welcome to week 4 lecture videos once again. And as you know, in this week we are discussing capital budgeting methods. Capital budgeting methods are broadly divided into two categories. One is discounted cash flow techniques, another is non-discounted cash flow techniques. Discounted cash flow techniques depend on finding out the present value of future cash flows and comparing them with the initial investment to decide whether we accept or reject a project. On the other hand, non-discounted cash flow techniques do not consider time value of money. That's why non-discounted cash flow techniques are less sensible and less popular among finance managers. So today we will be discussing two non-discounted cash flow techniques. One is book rate of return, another is payback period, and we also discuss the two discounted cash flow techniques. One is NPV, another is IRR. We already discussed NPV. We will be discussing IRR in the next video. So let's start with book rate of return. We previously discussed that net present value depends only on the project's cash flow and the opportunity cost of capital. But when companies report to shareholders, they do not simply show the cash flows, they also report book, that means accounting income, and book assets in the income statement and balance sheets. Financial managers sometimes use these numbers to calculate a book rate of return on a project proposed investment. In other words, they look at the prospective book income as a proportion of the book value of asset that's the firm is proposing to acquire. You can see book rate of return is calculated as book income as a proportion of book assets. And if this book income is greater than the cost of capital of a project, then we accept a project. And if this book rate of return is less than the cost of capital, then we reject a project. Now, we need to understand that cash flows and book income are pretty different. For example, the accountant labels some cash flows as capital investment and others are operating expense. So this is called capitalization and expensing decision. The operating expenses are deducted immediately from the year's income. The capital expenditure, on the other hand, put on the firm's balance sheet and then depreciated. The annual depreciation charge is deducted from each year's income. Thus, the book rate of return depends on the firm's capitalization and expensing decision. That means it depends on which items the accountant treats as capital investment and how rapidly they are depreciated. So book rate of return is heavily affected by manager's choice of accounting method and also the rate of return, I mean the profitability of the project. And that's why book rate of return is one of the least popular capital budgeting techniques. Next, we discuss payback period. Payback period is the length of time the project's estimated cash flows require to recover initial investment. So shorter the payback period, better it is because it indicates that less time period is required to recover initial investment. Now, accept reject decision of a payback period is sort of judgmental. Companies generally have a maximum acceptable payback. Now, if a payback of a project is less than the maximum acceptable payback, then the project will be accepted. On the other hand, if the payback of a project is greater than the maximum acceptable payback, then the project will be rejected. So you understand that payback is a simple technique. That's why, although it's a non-discounted cash flow technique, it is still used by finance manager because of its simplicity. Now, payback has two important limitations. First one is it does not consider time value of money, as I mentioned earlier. So it does not consider that cash flows earlier are worth more than cash flows those come later. And another problem with payback period is it does not consider the cash flows after the payback period. That's why the accept reject decision by payback period may be misleading. Here we have a few examples. For example, project A has an initial investment of $2,000 and cash flows are $5,000 each in year 1 and year 500 each in year 1 and year 2, and 5,000 in year 3. So you can see that 500, so 1,000 is recovered in up to year 2, and the remaining 1,000 will be recovered in year 3. So the initial investment is recovered in sometime year 3. That's why the payback period for this project is 3 years. Now, if the maximum acceptable payback of this company is greater than 3 years, then this project will be accepted. On the other hand, if maximum acceptable payback of a company is less than 3 years, then this project will be rejected. So this is all our discussion about the non-discounted cash flow techniques. In the next video, we will be discussing IRR and its advantages and disadvantages. Thank you.